Asia markets today are mostly in the red, with the Kospi in South Korea leading losses with a negative 0.26%. And that's as a softer than expected US jobs report fueled hopes that the Fed will start cutting rates sooner rather than later. Now, US job growth totaled 175,000 in April, and that's much less than the estimated 240,000. The unemployment rate in the US ticked higher to 3.9%, while expectations were for a flat 3.8%. And the jobless rate also edged up to 7.4%. That's its highest level since November 2021. Stocks jumped in the US markets on Friday, with traders now pricing in a strong chance of 2 interest rate cuts, at least by the end of 2024. Now, let's get more on this with George Khoury. He is CFI's Group Global Head of Education and Research, and he joins us now live from Dubai. Thank you very much for being with us this morning.
Thank you, Lorifika. Good morning.
So what is this jobs report signaling there in the US? We know the jobs market is easing, but hiring remained firm.
It is still too early to actually catch the optimism that is happening in the market currently and all the hike that we are currently seeing in the US equities due to the job reports. If we want to dig deeper into the job reports in specific for the past 2 to 3 months approximately, and we divide it into multiple sections, we actually see that full-time employment was actually really low for the past 3 months or even 4 months. What has been increasing the NFP for the past 3 months or 4 months approximately was due mostly to the increase in the part-time jobs and for many people having multiple jobs at the same time, actually, if we kind of dig deeper into the jobs report. So it's not too surprising that we started witnessing some drops and some decreases in the hourly payments and wages and in the non-farm payroll in specific. However, if we go back to last week in specific on Wednesday for the FOMC meeting and for the Jerome Powell speech, he was stating very clearly that the inflation that we are currently seeing is mostly triggered by the wages, which is kind of similar to what's happening in Europe to a certain point. So this is why once we saw a reduction or a drop in the non-farm payrolls and employment rates, when we've seen unemployment go up to 3.9%, which is close to 4%, which is a value that we haven't seen for the past 1 year approximately. So this will definitely make some changes and some volatility in the markets. But still, it is not clear and it's not sufficient enough to state that, yes, we're going towards a minimum of 2 rate hikes for year 2024.
Or predict when that's going to happen. That's all really interesting. All this is coming after a vigorous rebound from the pandemic shock in the US, although investors really still think the economy is pretty healthy there in the US. They call it a Goldilocks period financially. Do you agree? And what does it mean?
If we look at it from the behavioral perspective, yes, it is to a certain point, because if we kind of look in year 2023, if we want to dig deeper into the economy and what is happening in year 2023, we were supposed, practically and technically speaking, to enter into a recession. But what actually saved the markets is not the economy, and it wasn't the Federal Reserve, it wasn't the interest rates or inflation or so on and so forth. What actually saved the economy were 2 things: the drop and it was an extreme drop in commodities prices and energy prices in specific, which helped the Federal Reserve and helped in inflation globally and in the US. And from the other side, it was the trendy stocks and the mega cap companies that were actually leading the increases in the US indices, such as Amazon, such as Nvidia, and the increases that we have seen, Meta Platforms, so on and so forth. So the AI trend is what was actually leading to the increase in the US equities in 2023. But for how long will it be able to surpass the actual economy and how the economy is actually doing and what it is signaling? This is the true question that we are yet a way to discover.
George Khoury, thank you very much for your analysis.
Thank you.